Well, this is by far my least favorite time of year. The weather gets colder, the skies get grayer, football season is over, baseball season hasn't started yet, and 1099s start showing up in the mailbox. That's right, it's tax time. Every year I have to remind myself of the famous Thomas Dewar quote: "The only thing that's worse than paying income tax is not having to pay income tax." I do have one piece of good news for you, though, in regard to taxes. Thanks to Snowmageddon here the past week, Texas has been declared a disaster area. And so the IRS has extended the tax filing date from April 15th to June 15th. So that's right, June 15th for your taxes this year. You've got a couple of extra months. Now, for the last several months, we've talked about the factors driving markets and the outlook for 2021. We've looked at several factors that could negatively affect investor performance. One of those, it seems inevitable that taxes are going higher. The Biden tax proposal, even from the campaign trail, and the chatterings we're hearing in Washington here recently, seems there's a handful of revenue targets they're looking at. For example, increasing the individual top marginal rate from 35 to 37 or 38. Or taking and taxing the long-term capital gains and dividends at ordinary income rates. Or removing the cap or ceiling on the Social Security payroll tax. Maybe further limiting itemized deductions, and even cutting the estate tax exemption in half. Now, I know several of you are thinking, listen, Corey, I'm not in the top marginal bracket, so it doesn't matter to me. I hear you. Remember, we're not talking your individual tax return. We're talking about the impact that these things could have on the overall investments market, especially if it leads to changes in investor behavior. In fact, the last two revenue targets, the corporate income tax rate and fair market value date of death step-ups, could have major impacts. The corporate tax rate has been 21% here for the last couple of years. And the conversation is to potentially raise that to 28%, which will obviously eat into corporate earnings, which means profits, which means what markets trade on. There's even been some talk about an alternative minimum tax for corporations aimed at, let's say, the Amazons of the world, who follow the law but do everything they can to reinvest into themselves, or even in acquiring other smaller competitors or companies to reduce their tax liability, sometimes even to zero. And part of me thinks, well, good. There's an alternative minimum tax for individuals like you and me, so maybe there ought to be an alternative minimum tax for the big corporations. The other part of me thinks, well, if that's going to change the way Amazon and some of these other big corporations invest in themselves and in hiring people or investing in research and development and productivity, things that undeniably drive our economy, well, maybe we want to tap the brakes and think about that a little bit. The other significant impact could be the elimination of the stepped-up basis. Now that refers to taxable accounts. So we're not talking IRAs or 401ks or annuities, something that's in a tax-deferred account or wrapper. But in taxable accounts for years, decades now, when a client passed away, heirs would inherit those assets but get a stepped-up basis, which would reduce the tax that's due then. For example, if Dad had invested $10,000 and over several decades that had grown to $100,000 and children inherited it upon his passing, they would get a fair market value date of death step up, so the cost or value based on the date of his passing, which would then eliminate the tax on all of those gains over the years. Again, both of those, the corporate tax rate and potentially the fair market value date of death step up, if it alters investor behavior, could be a pretty major impact for markets as a whole. Now, all that said, campaigning is different than legislation. And the markets have been trading on two things for months now: the reopen from the pandemic and the stimulus that's on the way. And that remains the case inch by inch, day by day, as vaccines are administered, as herd immunity is coming about, even the treatments for those who do contract the virus. As all of that improves, the investor, the markets have been more and more optimistic, and that'll continue to be the case. As the stimulus is on the way, markets have enjoyed the last several rounds of stimulus, and this will likely be a very similar experience. But with that expectation on the way, those two things have pushed markets higher and higher. And the expectation would be that as that continues to be the two factors, market performance will be similar. Even two quick additional things. The Conference Board has a leading economic index. There are 10 factors that come into play and create this index of theirs that just released here recently. The January numbers showed a 0.5 percentage point increase year over year, which is good news that this economy of ours is headed in the right direction. In fact, they would state that as re-acceleration. Also, just here a couple of days ago, Fed Chairman Jerome Powell downplayed inflationary concerns, also explicitly mentioned that his views are that the economic conditions are a ways off from being free from the necessity for fiscal stimulus and monetary stimulus. In fact, even mentioning that we are still 10 million jobs away from the employment numbers that we had pre-pandemic. So it seems like we'll continue to have an accommodative Fed. So several things there to discuss. If you'd like to follow up, especially on some of the tax information in more detail, as always, don't hesitate to reach out. And until next update, take care.